Hello everyone, welcome to another episode of World of Oil Derivatives. I'm Greg Newman, the Chief Executive of Onyx Capital Group. I'm with the research team today, Martha, Vincent and Audrey. We've actually got a few research analysts who've recently joined, hiding away in the back as well. So yeah, that'll be interesting. What we're going to do today is focus back on the markets. So Vincent, what are you going to talk about today?
Today I'm going to be talking about APPEC, the industry conference. APPEC.
APPEC?
APPEC.
Okay. Yes.
APPEC.
APPEC.
Yeah. So the Singapore oil industry event. Yeah.
Yes.
You're going to be talking about that. Okay. Martha?
I'm going to talk a little bit about the situation in Australia with the LNG strikes, and then maybe open up to a bit of discussion about kind of where market manipulation and weaponization of energy prices comes into that.
Okay. Audrey?
Just going to do a quick market update, kind of bringing what we had last week.
Yeah, nice one. Why don't we start with that then? So.
Yeah. So remember last week, I think I can actually bring this up on screen. We were talking about, we were expecting the CFTC data to show the increase in longs coming back into Brent. So you can see on screen our prediction model last week. And actually the increase in longs was more aggressive than we'd predicted. And we obviously saw the decline in shorts, again, a lot more aggressive than we predicted. This week we're very much, I feel, kind of in wait and see mode. I know, Martha, you did a kind of market forecast yesterday, and we kind of feel like the market's a bit tentative right now. So we did our futures report and looking at some of the technical indicators. So you've got, the prices are now kind of in oversold territory. They've all passed the upper Bollinger Band, but we're still seeing that kind of increasing price on an exponential basis. So that's still kind of hinting at some bullishness, but notably we're seeing the open interest starting to track down a little bit. So, I think this week is very much about, okay, we've got the IEA are going to release their report tomorrow about where they see, oil demand and supply in the next couple of months. OPEC is actually going to come out today. And then we've got the US CPI data. So the consumer data, that's going to be key for,
macro sentiment. Yeah.
Exactly. Are the Fed Reserve going to up their interest rates, or are they going to stay? Because obviously the belief right now is that they won't. They're going to pause interest rate hikes for now. But earlier in the summer, that was the belief as well, that, they might pause and then they didn't. I think, if that's, I think the bigger one, I think that's bigger than the supply demand, unless OPEC and IEA, absolutely revise their supply demand and they see supply going way down and demand going way up.
Yeah. I don't think it's likely that we're going to get a shift in sentiment away from bullish, and the market always wants to be bullish, right? So, okay, so we've had a bit of a decent run again, week on week. We surpassed the 90 level on Brent.
Very comfortably. We're at 91.30 right now in
and that's
Brent.
The way we kind of work in this market, right? It's psychological levels, and you kind of get past those, and then if it's materially gets past those, so the open interest decreases and the kind of leveling off in volatility maybe a little bit makes sense around the psychological level, because people will arbitrarily just say, I'm going to take, I think 90 is fair value, so I'm going to take profit at fair value.
Yeah, I think it's really just from a technical standpoint anyway, and from a macro standpoint, it's very much just wait this week.
Yeah.
For, I think, just to see what comes about. We've got an estimation of a 2 million barrel draw for crude. That's not very aggressive. But they obviously have been drawing for the last 6 out of 7 weeks. But I think anything more aggressive than that will just further spur the bulls on. But I think the key one is going to be the inflation data in the US. I think for people just to take profit at these levels, I think that's going to be the big one.
We were saying last week that the bullish sentiment wasn't yet rife. It was a kind of positioning thing at the back end of the expiry in Brent. What was it, a couple of weeks ago? So trade houses and majors, the evidence, they're piling back into Brent. More longs again, aggressive entries of long again. Probably some people are getting a bit of FOMO now. So we're in that kind of, if you put a bubble graph, that classic expected bubble graph, we're heading more towards the greed and enthusiasm part, right, where the media is getting involved. And that's, we're expecting the headlines. I think that's what we said at the back end of the podcast. Are we going to see these headlines now that really start to stoke the fire? Actually, for me, it's been a little bit disappointing. It just didn't quite happen as I expected.
Yeah.
Basically, I still think there's room for a lot more hype. It actually seems the opposite. It seems people are this is probably about right, and we don't think it can go much higher because, I don't know, whatever the latest story is. So I think once we head more towards the mid-90s and carry that momentum, I think we could start getting well into the people rushing in, expecting that $100 per barrel psychological level. So that's I think going forward.
Goldman Sachs said that was their forecast. They came out last week saying that. Who else said it last week as well?
Saying that
they're forecasting $100 per barrel levels by the end of the year.
Yeah, it's easy clickbait, right? So you got to get it in. If it can be 91 it can get to 100 through momentum alone with positioning, you would think.
Yeah.
But how far are we? You said open interest decreasing. So if anything, a bit of profit taking.
Yeah.
So there's certainly more capacity for positioning to come in on the long side.
Definitely,
Yeah. Okay.
yeah.
So there we go.
And we're definitely not at like the oversaturated levels that we've seen, you know, earlier in the year at least.
Yeah.
You know, when we saw the market really, really saturated to the long side and then the whole banking crisis came and prices absolutely tanked. We're not seeing that at the moment. There's definitely a lot more scope for positioning to come in on the long side.
Cool. And Vincent, I know you've been just getting drunk in Singapore, but have you been focusing at all on products or anything like that you want to add?
Onto the products, no. So during these, I wouldn't say drunk, but conversations with drunk traders, there seems to be a lot of bullish sentiment as well. The APPEC events came at a very, I would say, opportunistic time because it happened it was taking place just after Brent hit the crucial $90 level. So a lot of traders were very optimistic, and at the time we also had a bullish view on Brent as well. So at the very least, I was saying when people asked for our opinion, I was mentioning at the very least there wasn't much downside. There was a lot of investors. The market really wants to be bullish, seen from the CFTC market positioning data, and at the same time, you know, the headlines coming out that OPEC, the Saudi especially, were going to extend their production cuts into December. That really triggered a bullish reaction from the markets as well. But at the same time, with the product side, the key points were still surrounding the fundamentals. Of course, at the time the Chinese export quotas was released on the first day of September. As well as, you know, people talk on the LPG side, the Panama Canal logistical issues that was really blowing out the FEI-CP differential. And at the same time, a lot of discussion on the very strong refinery margins. That was on the back of strong gas oil as well as strong gasoline. People wondering if that was, you know, if the strength was going to continue.
Where are we at now, Martha, with the refinery margins?
Yeah, so the refinery margins have been really strong. They dipped down. I think they hit a low on the 4th, a recent low, and then they've been supported back up again. And in the Asian refinery margins anyway, that's definitely been supported by the gas oil. And I'm sure that's replicated in the European gas refinery margins as well. If Audrey, you could pull those up so we could see them on the screen.
So essentially, it's important because strong refinery margins gave, you know, a good excuse for, well, like a genuine buying excuse for refiners in the prompt, and it made sense. The data Brent market was responding very well to that, and the physical differentials have improved. A lot of buy side activity from refiners, but for the refinery margins to keep pace with this rally is very significant. It just means nothing changes, right? They just keep buying and they keep generating and keep processing, and they'll run at 100%.
So just bringing up on the screen, so you can actually see, so this is the Onyx European refinery margin that we've created in-house. But if you look at, you know, the changes between the 5th of September and the 11th of September, so you can see that strength coming back into the products, notably gas oil as well. So you can see
Wow, so it's rallying with the rally past 90.
Yeah, so the refinery margin in the M1 is now up like 250 in that week. And this is being driven by this gas oil, the strength in the gas oil.
Okay, so yeah, we were saying a bit of that at the back of the N1, right? It was kind of gravitating up for no real reason.
That's a really hard. Remember we were talking about, it was just kind of, it was more just flow driven, people just getting on the back of it. And I'm like talking to the traders on the desk, they're very much kind of what they're seeing anyway is it's more that people just are afraid to be short rather than, you know, necessarily looking to be long, because obviously prices are still, barring last year, like at a historically high level. But then there was a Hurricane Lee, is that the one? I think people kind of piled into some length on the back of that because they were afraid that some infrastructure would be taken out. So I mean, I think it's kind of like that in gas oil. I think everyone's just afraid. There's obviously the lingering, okay, we're not going to have Russian diesel supplies, and then it's just, even though levels look high, I think people are afraid that if they don't get in at this level, if there is some sort of, you know, disruption.
What's also significant is across the board there was growth in the cracks. So NAFTA went up, EBOB went up, everything went up.
Yeah, and we're still seeing people like positioning long again in RBOB, so we're seeing more length building even there, and that's just all off the back of like the strength in Europe still.
I just think you can't argue. Yeah, I mean, I was going to say, you know, if it was a temporary psychological thing and the fundamentals weren't necessarily there, you start to see that in the physical differentials and the margins and the cash. But if they're continuing to rally and we're continuing to stock draw, you kind of have to accept that there is a fundamental story here that is real and ongoing, and it's in the forward curve. The main trade is buy flat price, buy Brent spreads. I know it seems vanilla, but it's but that is what it's saying. It's undervalued benchmark because refiners can just make a hell of a lot of profit. There's clearly not enough supply. So it's just got to get to the point where it decimates demand again. And I think I was reading something about that this morning about, demand destruction is going to have to be a topic of conversation again. But remember, it's a different thing to last year. Everyone has so much recency bias. Last year, demand destruction around $100 per barrel made sense because the cracks were astronomically high.
Yeah.
Even though they're high, they're not as high now.
No.
And so that will probably, there's a bit of respite there. So I think we got a way to go from a momentum basis. And I think that's just a good way to summarize it, basically.
Yeah, I mean, gas oil September flat price hit $1,000 yesterday, which is also key psychological level. And energy inflation is another topic of discussion again. What's going to happen going into winter, but there's also a psychological angle which I can referring back to APPEC, because as from our trader meeting notes report last week, it was often mentioned for most products that liquidity was really drying up because many of the top traders were flying to Singapore for the APPEC event. So during that time, especially during the London windows, which is Singapore evening time, that's when the cocktail parties happen. That's when the traders get drunk.
So there's a liquidity crisis in two different ways.
Exactly, liquidity crisis.
If you bring up my screen, I have like the front Brent Dubai.
Drunk. What are you gonna say?
I was bringing up the front Brent Dubai. So I mean, if you look at that last week, it actually we had the OPEC cut news on the 5th. You had the prices tank, but then they kind of ticked back higher again, and obviously tanking again into this week. So it's down like 20 cents today. But we spoke about that in our trader meeting notes as well, that we expected this once kind of traders came back, because a lot of the big players were just pissed.
See, it seems that in distillates, especially the cracks, there was a lot of selling resistance Monday, Tuesday, Wednesday last week. So the gas oil swaps crack was around $31, $32 per barrel in the front. But then on Friday, perhaps as a lot of the traders came back, they were, the selling flows dried off. The selling flows were taken out, and then the bullish traders came back, expressed a view, and all of a sudden the crack rallied by $4 a day, finished on Friday night at around $36 levels. And the bullish momentum continued to happen into this week as well. So perhaps it's very much a thing of market sentiment, as well as the number of traders in the market, the relationship between like market positioning and liquidity. That's what we're seeing here. So APPEC is a really great case study for that. Especially because in Brent flat price, there's always going to be a lot of liquidity, the hedge funds and stuff. But during the event, it's really the oil products traders. They are all networking, all gathering, as well as that's, they make up a lot of like liquidity and trading volumes in the market. So once, their absence and their return will really have material impacts in the market
and the
price action. Yep.
Is there anything else like from APPEC or whatever that you want to discuss?
For me, it was my first time attending. I'm sure for you, you've been there like many times before, but it's for the first time as like quite a bit of novelty. But talking to the industry veterans, it's more like perhaps they want to go like once every 2 or 3 years. But it seems like it's it's a someone said, it's people go there for the networking, but it really is an opportunity for them just to get free food and drinks pretty much.
But I think what I saw this time is again, it's still the post-COVID thing, right? And people having the excuse to go out there and meet each other. And there was some decent amount of news from industry leaders coming out and headlines about views, and very clear from the actual conference itself that the trade houses and majors are signaling bullish again after having a bit of a lull during the year. So it's going to be an interesting Q4 without a doubt. And I think from the sounds of it, it's all geared up already. So I think the question now, just going back to what we said at the very beginning, is where do you hold your risk? Like what does the future hold as you get into Q4? Once the gasoline drama is over, the hurricane drama is over, the driving season is now over. It's going to have to all be about this winter story again and storage. And you are seeing headlines creeping in about that. And the fact that gas oil is rallying so much is is going to be taken by some journalist, right? Like that rally in the gas oil market, as you said, the $1,000 per metric ton psychological level. You know, it's there's going to be questions asked now about LNG, about gas, about that, and Martha, you talk about it in a sec. But as I say, if you're bullish, I still believe with refining margins holding firm, with Brent structure not ridiculously high, it's still got a way to go.
Yeah.
By that I mean the time spreads, they're around 60 cents or whatever in the front. It's looking like the market is a bit tentative, but actually all the signals are, there's the capacity to take more length. There's real underlying fundamentals there with the physical diff and therefore the time spreads. And I would argue that it's every time you buy a crack now, you're just like basically tempting fate, because it's still bullish to buy Brent, but it's not really bullish to buy gas oil cracks because it's a differential, right? Do you really think gas oil is going to rally relative to Brent? That's going to need a really serious economic improvement, which could happen, like you say. But I just think the risk reward, it's better held in Brent right now or WTI.
Yeah.
That's kind of it in summary. But it sounds like people are thinking across the board bullish, and obviously traders will figure out however they want. But I think Q4 is when things will come home to roost. People think about their bonuses, their year ends. And so, yeah, it's definitely going to be interesting. So, Martha, why don't you talk about the LNG stuff that you wanted to?
Yeah, of course. So this has kind of been rumbling on for, seems like weeks now, with the Chevron and the offshore alliance of the trade unions, I think made up of the two trade unions. And the Chevron have come out and said that they need the labour regulator to intervene, that the deal that the trade unions want is untenable and it's not going to happen. And it's reached a bit of a stalemate. And by doing this, they've brought the trade unions originally wanted the conversation to be happening in November, but it's being brought forward, and people are saying that this is going to cause more aggressive striking, and they're bringing out this, it's 5% of the world's LNG supply, which has already been undermined previously by, I know our traders said that's it may only be up to 1.5 cargoes, and it's such it can be so overblown when it can be put into a statistic like that. So I was just going to use this more kind of a talking point rather than this specific incident, because I feel like this is it's been played out, it's been rumbling on for so long that it's kind of lost momentum in the markets. But to what extent do you think that something like a strike, I know we had the French strikes earlier this year, would this ever be a big enough threat, this kind of weaponization of energy prices? Would it ever be a good enough weapon to use by the unions and the
I was just going to say, you would be looking at the prices every day. So I think it's maybe not fully understood exactly why, but that maybe they do understand. But if this had happened 2 years ago, or let's say 2019, then nothing probably would have happened, to be honest, in the price action. But it's just that it's a huge move. You can bet that Chevron, Jesus, this is a big deal, and then they're probably getting pressure from the industry. Maybe not a bad thing, but just when I say pressure, I mean people asking questions, people being all over you. So that's got to feed back to the strikers, right? Clearly, we're having a big impact, and I imagine they'll run away with it in their imagination. It's if we strike one more day, the price is going to go higher. It's look, at some point, prices rise in these scenarios because of the risk, the risk premium, right? Could it become something big? Because technically, Australia, a huge amount of LNG, this could be huge. So traders are buying because they're worried and all the other factors. But the longer it goes on, and the longer you see the material impact being, it's kind of manageable, you the impact of the strikes diminish, right? It's always the same thing. So it's a bit like OPEC cuts. They were OPEC cut. Eventually everyone was like, well, it's not really working, so I don't really care.
Yeah.
And then they went as far as they went, and finally it was. So I think basically yes and no, right? I think if they keep using this card and they think it's going to have an impact on price and therefore they have a better bargaining chip, that's fine until it doesn't work, and it probably will stop working soon. But then at the same time, it does show you that a strike in one place can have a very different impact from a strike in another, whereas the physical difference in terms of the actual operational supply might not be any different. I think that's really confusing to people, right? You were mentioning just before, Martha, there's in 2017 a hairline fracture in a North Sea pipeline, just a hairline fracture, right? It caused shock waves in the price action, the time spreads. It was mental. And then they had to declare force majeure on the cargoes, and then the price reporting agency Platts, that prices data Brent, didn't allow companies to bid for those cargoes that people knew didn't exist, so that they made sure the price wouldn't go to the moon. But it was all mayhem. Yet it was only a few cargoes. Whereas, a big like pipeline explosion somewhere else, it's like, but it's not linked to a benchmark. It's not going to have any impact on the actual price of a benchmark that links to a contract. So no one cares. We've talked about this before on this podcast.
Yeah.
It's just one of those things. So I think the average striker is probably not really aware.
Yeah.
But now they're like, hang on, it's probably confusing. But the real answer is because LNG is now a huge deal because we had to replace all the Russian gas. I was just
in my head thinking that as well. Is like, do you think like even like regular Joe on the street is way more aware of LNG now since like the Russian invasion of Ukraine? Like
Definitely.
Obviously working in the industry is one thing, but I think like even my like family and friends know about gas now in the last kind of 2 years since the war. And
well, they probably knew about natural gas, but it's the LNG component.
It's the LNG because I hear about it much more now in like mainstream media and all about like these LNG storage facilities. Like obviously, if anybody didn't guess by my accent, I'm Irish, and like that comes up in like the Irish media all the time about the fact that we don't want to build this LNG storage facility because we want to go to renewables, and it's all this kind of conversation because it is that transition kind of fuel, or a lot of people look at it like that. So, especially in
what it's marketed as. I think that's what the public see it as anyway. That kind of like stepping stone between what we're at now and like renewable.
So as that like renewable narrative stepped up, so the
clean fuel is typically what it's called.
Yeah.
But to your point, though, Martha, about weaponizing these things, I mean, this is like a tale as old as time. And I think people like learn about moves made by governments or unions or traders or whatever it is, and they go, oh yeah, they could do that again. But it's never, you're constantly playing catch up for this. We'll find out later on. To me, that's basically OPEC's whole job. That's how they see it. They've got the cards in a poker game, let's say, and it's how they're playing them. And when they overplayed their hand, the market was like, well, we don't care. When they play it right, it has real impacts. And and they clearly just went all in, or Saudis went all in this latest one.
Yeah.
And it really did have the impact. So it's all games really at the end of the day. So for anything that's going on like this, there's obviously someone behind trying to profiteer from it, trying to puppet master it. It's always going to be the case. Whereas I don't think that was behind this, to be honest, though, is in the first place.
It was genuinely these guys
I think so.
want better work conditions. They want better pay.
Of course, I just thought it was interesting. I was originally going to compare it to that hairline fracture in 2017, and it's just an interesting thing to consider. Do you think that other PRAs will step in, or do you think it only has to happen to something that is so close to the benchmark that they have to step in?
That's what I think it's about, because the Dated Brent benchmark was settled to, not only was it settled to all these North Sea fields. 40s is the one that usually sets sets crude, especially before WTI Midland. This was before WTI Midland. So the fact that the 40s pipeline went down, it's like these are the cargoes that are going to set. So it's like there's only 19 cargoes that were going to set the price that month. If you've taken like half of them offline, and they're the ones that are setting the price, it doesn't matter that you've got all this other oil, it's still going to cause a massive rally.
Yeah.
So that was so localized and niche, whereas this isn't localized, right? This is Australian LNG. The JKM benchmark for LNG is Japan, yet it's the TTF in Europe that's actually responding the most.
Yeah.
So it's a global shock event, global supply shock event, which I don't think you can talk about force majeure niches on settlement, because it really is a supply issue. But yeah, the only thing to add to that is like you probably have to go back about 8 years ago, when there was the last time where the market used to have this risk premium on Brent. So you'd be like seeing the news that, so you've got $5 to $10 per barrel on top of Brent because of the risk premium. And it was just like a thing people accepted. And what it was effectively saying was, because the market is effectively in a slight supply deficit, that was the state of the market like maybe 10 years ago, or at least what traders were used to when they made money. And because the market was kind of in a supply deficit on balance, it was basically like if there was a war in the Middle East, or if there was something that was happening, and there always is something happening, then oil would naturally be something you buy, and everyone starts to buy up and expect to get a return on in these kind of events.
Yeah.
And Syria was probably the last one, like with the Obama red line times in 2013. It was like really significant. The price was rallying really just on Syria. Syria's got no real oil, so it wasn't such a big deal. But then I remember kind of from that point onwards, we kind of moved into more of a supply glut, and you had the 2014 sell-off and the shale oil and all that. So every time then there was a crisis, annually you'd get a crisis. in the Middle East, and then suddenly there wasn't this risk premium anymore.
Yeah.
People were like, that doesn't really exist because there's too much supply in the world anyway. So just because, Trump even in 2019, or we might, fight Iran, might have a war with Iran, we weren't getting a rally in Brent crude prices. There wasn't this risk premium. So anyway, what I'm trying to say is LNG is very different now. It's like where Brent was 10 or so years ago. So LNG now, if something happens around the world, like an Australian strike, there's not enough LNG in the world. It could be a massive risk have massive shockwaves. Do you see what I'm saying?
Yeah.
So therefore, this risk premium makes more sense. So you might see that more in TTF, just ongoing. Anytime there's a hint of a scandal or supply shortage, like just buy it up. Do you see what I mean? So that's a big shift.
But then at the same time, though, then looking at the notional value, TTF just range bound between like 30 to 40 euros, but compare that to this time last year, it was going up to highs of 500. So it's like last year was significantly higher.
I don't think you want to compare that though. Isn't if you take that out as an isolated event, like go pre 2021 or pre 2020, like gas prices were way lower.
Sure.
So this is a significant move on a historical basis. You can't. I don't think you can relate it back to like a full scale war and like the blowing up Nord Stream 2 and Nord Stream 1. That's a very different scenario. Do you see what I mean?
Yeah, a bit of a recency bias, I guess.
That's what I'm saying. Yeah. If you look at it, this is, or I'm just trying to predict 2 to 5 years out. This is how the market will trade now because LNG is such a scarcity and it's so needed to replace the Russian gas. There's more likely to be these kind of risk premiums when these supply outages or threats of supply outages comes. That's what I'm saying. Yeah. It's funny. I remember just a random anecdote. So I was short flat price in 2013, and then like ISIS came in to Iraq, and the prices did rally for a bit, and I got stopped out, and then they went all the way back down because people were like, actually there's just too much supply still, and it just sold all the way down and went all the way down to like $40, and it's just one of those things. It's like the psychological shift. But I remember me and my trading manager were arguing about it, and I was saying, I should have stopped out earlier, and he was saying, yeah, you only want to stop out earlier because like you're not sticking to your trade plan. And I'm like, yeah, but like what, this is such a big event. Like you're saying, 2022. I'm like, yeah, but it's like a completely black swan event. So I remember the CEO got involved, and I was like, come on, I should have stopped out earlier. And he's like, well, yeah, if you got short WTI and then Cushing blows up, like you're not just going to be like, well, I got to stick to my trade plan. It's like, well, that's why I'm kind of saying to you. So in TTF, it's like there was a war and a pipeline was blown up. That's very different to, do you know what I mean? Like, there's not much impact right now because 32 to 40. Do you see what I'm trying to say?
Yeah. So I mean, like on a historical basis, it's still very significant.
But in that time last year, it was like, man, this is like unheard of times. It's not a balance of probability thing. It's like, no, things are being blown up and complete supply has been taken off. It's just,
major anomaly.
Yeah, you have to change all your models at that point. You have to change the complete way you're thinking, and yeah.
I mean, that's just because I've entered the market last year, so actually it was like just by analyzing it, seeing like prices going up to historical highs.
Funny.
So
your first year is like the normality is like that.
It feels like normality is like 500 euro TTF, like $60 gas oil cracks.
Well, you'll never be hindered in terms of possibilities because a couple of years before you joined, we had the negative WTI. So we've now just seen like everything you could possibly see, it feels like. And then what that will encourage is like, I think there's a lot to be said about these psychological levels. We talked about it at the beginning of the podcast. If you now know that oil can go negative, because it wasn't assumed that it could, and you now know that TTF could be 500, then anything can happen in between. So suddenly people believe when they're long or short, they kind of set new targets. Do you see what I mean? And that changes how people take profit and stop out. You see what I mean?
Yeah.
It's gonna be interesting for the next. That's why I think the trading environment will be fantastic in the next 5 years at least because of that change.
Do you think people will take more risk because of it?
I mean, risk is a function of position size, right? So as in, you can still expect a lot bigger of a move, but you can dial down your position size so that you still have the same amount of risk on. But I think, in answer to your question, I think people will expect bigger moves though. And it probably will translate into more risk. Yeah. There's more money on the table in recent years. Yeah. And people have got a lot of money to play with at these companies. So I kind of agree.
Even though this year the market is kind of like, no, I don't have as much this year. versus last year.
A bit of return to normal straight away.
Yeah.
No, I'm with you. Well, I think that was a nice one. That was a good diverse conversation. So thanks, guys, for preparing that, and welcome back, Vincent, from your drunk escapades. And we'll speak to you all next week. Thanks for listeners out there. See you again soon.